Hi everyone, welcome to today's session. We'll just give it a couple more seconds as we wait for people to stream in. Right. But in the meantime, there's a couple of poll questions that we are curious about. So help us out, answer these poll questions, and then we'll go through this shortly as well. All right, I think it's 6:01 p.m. All right, and we're gonna have a few I would say a very interesting hour, right, from 6 to 7 this evening. We do have two external speakers on our end here, and they are very, very established players in the industry. So I don't want to hold us up too much. Right, let's start the session off live today. Okay. All right, so we are going to have a very packed evening today, right? We're going to have a quick introduction, and then I'll pass it over to Ritesh, who will give us an outlook on the interest rates. After that, Jeff will actually be bringing us through some of the impacts on the yield asset classes, and then we'll finish it off with a panel discussion, right? And then, of course, that's where we'll bring Gerald in as well, right? And followed by any questions and that you might have. So just a few housekeeping matters. If you have any questions, feel free to use the Q&A tab to raise it up. All right. This session is recorded, right? So we may be actually streaming it live on YouTube later on, right? But like I said, it's always best to be in the live session so that you can actually raise any pertinent questions that you have. Okay. So my name is Jason. Oops, so sorry. My name is Jason. I'm from Science Advisory Team, right? And first up on the panel, we have Jeff Howie, right? For those of you who are familiar with him, Jeff has a very long career, more than 25 years itself. We had a chat with him earlier this morning, and I think he described himself as a little bit more of an old school character, right? Fun fact, right? He is a very accurate weather forecaster. Right, if you want to find out more, please direct message him after that. Jeff, you want to say a couple of words to our guests here tonight?
Just a good evening, and I'm really looking forward to this next hour, the hour of power, hopefully. And really great to be here with Ritesh and, of course, my good friend Gerald Wong.
Right, and of course, yes, the next person itself is Gerald. Right, so Gerald is actually the founder and CEO of Beansprout, a very established FI here in Singapore. So the mission of Beansprout, obviously, it aligns very closely with me personally, empowering you to actually achieve financial wellness. So Gerald, a few words from yourself.
Hi, everyone. Thanks so much for joining today's session. I think we are in a very interesting point in the market where we see movements in terms of the REITs and different asset classes. So hope to be sharing more of our insights with everyone who's on the webinar today.
All right, awesome. Thanks a lot, Gerald. And before I forget, fun fact about Gerald is we have Jeff, who is a weather forecaster, and then we have Gerald here, who is a very accurate earnings forecaster. Right, so do reach out to him. I'm sure that's a pretty interesting thing to be forecasting about. Right, and last but not least, we have Ritesh. I'm sure he's a very familiar face here at SIFE, right? He's the head of investment and advisory team. Right, and Ritesh, maybe I'll just pass it over to you. Any few quick words for our audience here tonight?
Thanks, Jason. Great introductions, and I wish all my forecasts for the asset classes also turn out true, piggybacking on Jeff and Gerald. So, yeah, let's hope for brighter times ahead.
All right, awesome.
Yeah, let's kickstart this.
Yes. So first up, I think let's look at the poll question that we just shared with everyone. I'm just sharing the results right now. So in the poll question, we asked like, are you currently investing in REITs or Singapore banks? And pretty interestingly, I think more than 60% of our audience actually replied that they are invested in Singapore REITs at the moment, right? Followed by 30% into Singapore banks and another 30%, 28% that is not invested in either of these asset classes. So maybe first off, Gerald, any quick comments?
Well, I think it's quite interesting that we still have a lot of interest in the Singapore REITs. I think over the past 12 months, we've seen quite a bit of volatility in the REITs performance. So hopefully with today's sharing, we can understand a bit about what is driving the kind of share price movements about the REITs and help us to better understand what could be a potential way to think about the REITs going forward.
Fair enough, fair enough. Jeff, Ritesh, you want to add on anything?
It does make sense. It matches the flows in terms of most retail investors have been net buying the REITs. In fact, that's the sector that has seen the most retail inflow this year. And yeah, for the banks, I'm surprised it's not as much, but as we might be able to help the investors with what drives the banks and so forth tonight.
Yes, Ritesh?
All good. Let's move to the next question as well. I think you had another one.
No, it's fine. I think maybe for the rest of the participants here this evening, I'll just do a quick 2-minute sharing of Scythe if you're unfamiliar with Scythe and joining us here for the first time. So let me just, okay. All right. So Scythe itself, we are a digital investment platform, right? We have a very closely aligned mission to what Gerald shared earlier. We want to empower people for their financial wellness as well, right? So we do believe in providing the tools, the resources, and obviously on the advisory aspect, we do assist and support our clients as well. We're located across 3 countries, Singapore, Hong Kong, and Australia as well. Right, so yes, this is our mobile app, right? We did have a couple of awards this year in 2023. So best personal finance tech as well as the wealth tech. Right, so a very slick looking design. And I think if you have joined us for the last couple of sessions, you would actually see that some of our slides, or rather most of our slides, are looking a little bit more polished right now. So we just had a brand refresh, right? I'm pretty excited about how the whole app and the slides look as well, right? So we have over 100,000 investors. I believe this was achieved in 2022 itself. These are the 3 pillars that we do emphasize on consistently, right? And this is our journey to date, right? So we started in 2019, right? I think since then, we've hit a couple of pretty huge milestones, Series A, Series B funding as well, right? And then we have a couple of launches. Right. Ritesh, I think you might want to chime in here. You've led most of these milestones yourself as well.
Yeah, no, I think it's been an incredible journey so far, and I'm really thankful to all the investors who have trusted onto our platform. Even though I guess like it's not been the most great time when it comes to returns, and more specifically over the last 2 years, it's been very challenging. So hopefully as the markets turn in 2024, we can also, get clients to really grow their wealth alongside our portfolios and solutions. So yeah, really looking forward to brighter times ahead.
Yep, definitely. I think we all are looking forward. All right, so Ritesh, I'll pass the segment to you entirely. Outlook on interest rates.
Thanks, Jason. Hi, everyone. Very excited to be hosting this session today. Jason, if you move on to the next slide, let us start by taking stock of the last 3 months, right? So contrasting the first half of the year, the last 3 months have been challenging for the markets and for investors in general. The US Treasury yields, which you can see on the right-hand side, it spiked to 5% for the first time since July of 2007, after Fed's higher for longer interest rate stance in its September meeting. This combined with higher oil prices sent kind of ripples through the financial markets, with major indices entering into correction territory, meaning like a drop of more than 10%. Now, obviously, questions around whether the central bank will hike rates further or prepare to cut them, and when that would happen, have grown louder and louder. So, and that is one of the key reasons why this week's inflation data was very eagerly anticipated, as it is one of the many, or like one of the two main gauges for the Fed to determine its interest rate policy kind of going forward. Now, the good news is that the overall headline inflation number that came out declined to 3.2%. So it grew by 3.2% versus 3.7% in the September print. So meaning that the inflation numbers are trending down, and it continues to show like a broad slowdown. Mainly, this is the headline inflation, so includes like oil and food as well. So the gasoline prices is one of the key ingredients which led the retreat for the current month. But it's not just the headline inflation. Even if you strip out food and energy, the core CPI, or the core inflation, also grew by 4% on a year-on-year basis. And this is the slowest 12-month inflation rate since September of 2021. So it is not just the headline number that is coming down and trending down. It is also the core number that is trending down. And one of the most encouraging part of the October print was the continuing moderation of shelter and housing inflation. These are parts of inflation which contribute almost 70%, or they account for 70% of the overall increment in the core inflation numbers that you see. So, seeing moderation in these specific parts of the inflation metric is very encouraging to see as we move forward. And now, obviously, this had an immediate impact on the markets overnight. So if you saw the markets overnight, the 10-year Treasury yield retreated below 4.5%, right? So it was a quick move down. You can see on the right-hand side, again, the 10-year Treasury, after hitting that 5% mark, is now below 4.5%. And we also saw like a broad-based rally across equity and bond markets. S&P 500 was up 1.9%. NASDAQ was up, higher than 2%. And in general, the data basically shows that there is a disinflationary trend, which is now firmly in place, right? I think over the last few quarters, there was this question that is the inflation really trending down consistently or not? Because, you had 1 month of good data, but another month, the inflation numbers trended up. But I guess with the latest print, you can see that now we can see a consistent trend of inflation coming down. And that kind of increases the prospects of Fed having a clear stop in its rate hiking policy, right? And there are some other data points that we can look at as well. So if you go on to the next slide, which can really help us kind of decipher the Fed policy path going forward. So far, I think the Fed has kept a hawkish stance, right, on keeping the rates higher for longer. And this is mainly to rein in inflation and the fact that the overall economic data is still very, very strong. So if you look at the macro data, while the broader economic metrics do look very positive, we can also see that there are small signs of stress emerging within different economic sectors. So while the US third quarter GDP grew at the fastest rate since 2021, clocking at 4.9% annualized, if you look at some of the other data points like the ISM manufacturing PMI, that contracted to 46.7, meaning that we are not in a growth trajectory on that front. Non-farm payroll, another metric which kind of gives a sense of the labor market, it increased by 150K in the latest print, where the expectation was 170K. So again, a little bit below expectations. The unemployment rate trended up a bit, so it was expected to be 3.8%, but it came out to be 3.9%. So a little bit higher than anticipated. And similarly, the personal savings rate, the housing starts, these are metrics that are starting to show early signs of pain and stress. Now, again, the overall growth metric still looks very, very positive. So when you look at GDP number, 4.9%, that's great. For the overall year basis as well, we should be ending the year at 2% plus, overall GDP growth. as well as if you look at the unemployment rate, that being below 4% still is a very, very healthy picture. So I would say there is a mixed bag of data. The overall economic strength looks intact, but we are seeing some of these early signs of stress, which means that when it comes to the Fed policy moving forward, if you move on to the next slide, there is a greater market expectation that the Fed is now done with its rate hiking cycle. And as we move forward, while the Fed might not be in a hurry to cut rates anytime soon, but we have clearly peaked, right? So if you look at this particular, chart, you can see that, going into 2024, the probability of rates increasing is, much, much lower, and it remaining in that 5.25 to 5.5% range remains so until at least, January of 2024. But as you move towards the second half of the year, you can clearly see that the trend is to go down. Now, at what pace does it go down is still a question mark, but clearly you can see the trend is that the interest rates will start going down as we move into the later half of 2024. So in terms of, if you go to the next slide, the path that we are looking forward to, I think overall, when you look at the market expectations are clearly on the downtrend, where we have reached the peak, and we are looking at least a couple of rate cuts going into 2024. Of course, the Fed will be very circumspect still. It wants to have a strong stance against inflation. So we will keep a watch out in terms of if something changes. But at this point, looking at the overall picture from the key metrics that the Fed is looking at, whether it is inflation and unemployment, but also looking at the other side of economic strength and slowing growth. I mean, this year, if you look at the latest earnings prints and all as well, 82% of the companies in S&P 500, they beat their earnings expectations. So still not seeing very high stress levels. So there are early signs, but that should mean that essentially if inflation is coming down in a clear pace, the Fed does not really need to keep the rates or hike rates any further, right? So I think we're definitely at the peak from that standpoint. So with that backdrop, I'll hand it over to Jeff to cover how different asset classes have maybe behaved recently, as well as what we can anticipate as we move forward.
Thanks so much, Ritesh. Yeah, I'd like to just hone in for the 15 minutes or so on those parts of the market here in Singapore, our stock market, that the interest rate moves have had the most impact on. So maybe we can go next, Jason, to this slide here. Essentially, the weak external demand across the world and these tighter financial conditions have really moderated global and local growth here in Singapore this year. It's had very much a measured impact on the stock market as well as investor activity. And the two directly impacted stock sectors in Singapore, most, impacted by interest rates, are the banks and the S-REITs. And this covers quite a large tranche of our market when you consider that just over 25 cents in every dollar that goes to work in our stock market every day is going to one of the three banks, DBS, OCBC, or UOB. And then you also have around 20 cents in the dollar that goes to work into the S-REITs every day. So there is a dividend appeal there too, because when you consider those two segments alone make up pretty much close to around 3/4 of all of the dividend distributions that actually come from the SGX stock market. And the current 12-month trailing yield of the FTSE ST Banks Index is 6%, while the 12-month trailing yield of the IHS REIT Index, Leaders Index, I should say, S-REIT Leaders Index, is also 6%. Over the past 5 years, a trio of DBS, UOB, and OCBC have averaged total returns in the vicinity of 50%, that's 50%, and that has really led the STI, as you can see in this chart, higher than its regional peers. And from the end of 2021, the trio of banks have actually averaged around 16% total returns. Jason, can you flick through, please, mate, to the next one? So while the banks have averaged 16% total returns, the FTSE ST REIT index has seen reciprocal negative total returns of 16%. That's from the end of 2021. However, it's still, at the same time, it's outperformed its global peers over the past 5 years. So we had a good foundation in terms of performance going in to the rate hikes that REITs has been going through. So this is all since the end of 2021 really coincided with tighter conditions. The 10-year US Treasuries moved from 1.5% at the end of 2021 to 5% highs seen last month. And that also coincided with Singapore 3-month compounded SORA rate rise from below 0.2% up to 3.7%. And this has all been on the back of rising inflation and higher rates to contain inflation. But as Ridesh was discussing in his presentation, I think what's interesting is that markets just recently have moved somewhat into a new phase. And that's really led by the Fed preferred measure of inflation. That's the USD PCE core deflator. It's now at 3.7%, and that means it's actually now closer to the 2% target than it is that closer to that 5.5% high back in September of last year. So back on the 1st of November at the FOMC, the Fed actually affirmed multiple times in that press conference that the impact of preceding rate hikes were still working their way through to the US economy. And that pretty much aligns with conventional economic theory that it actually takes a good 12 months or so for a rate hike to fully work through an economy. So that is one reason why those expectations for a rate hike in a month or so actually have come down from around 40% in August to around 5% thereabouts at the moment, come down right off a cliff. Now, because of that, what we've seen is our FTSE ST REIT index, which, as I said, is down 16% since the end of 2020. It's actually up 8% since the 1st of November, while on average, the banks have actually been flat because the banks have, as I said, moved in a different direction with those higher rates to the REITs. Can you go through to the next one, please, Jason? The yield tilt of banks, yeah. So onto the banks, because the banks actually make up 45% of our STI and are a really large cornerstone of the FTSE Singapore index, the trio really have had a significant impact on Singapore's branding as a stock market with comparatively high dividend yields. If you look at, as I said, their average yield is about 6%, and the combined market value or market capitalization of the trio is around 190 Sing dollars. So those three banks, DBS, OCBC, and UOB, have actually paid out 10 billion Singapore dollars of dividends over the past 12 months. And at the same time, near 6% yield for the IHS REIT index, with a combined market cap of 90 billion Sing dollars, implies the REITs have paid out around 5 billion Sing dollars in dividends over the past 12 months. Can you go through to the next, please, Jason? As of the end of September, the FTSE Singapore index maintained the highest index yield across Asia Pacific at 5%. I think it was followed by Indonesia at 4.6%, and you have FTSE developed yield at 2.1%. By comparison, your FTSE Australia is at 4.4%, and FTSE Hong Kong is at 4.2%. Over those 12 months, both FTSE Singapore and FTSE Australia were both up 14% in US dollars. And that's for the 12 months ending September, while FTSE Hong Kong was flat. And can you go through to the next one, please, Jason? Yeah, so the trio, the three banks, they're among the 5 biggest weights of the FTSE ASEAN index and the 5 biggest weights of the FTSE ASEAN Target Dividend Index. And this Target Dividend Index, it's a new index. The trio of banks make up around 15% of the FTSE ASEAN Target Dividend Index, and it's part of a new global series that maintains a dividend yield uplift target while attempting to mitigate those risks of a yield trap. But I'll look at the additional dividend index to just really explain why these are high dividend stocks. If you go through to the next one, Jason, to look at this chart that I've got up here, these are the top 10 biggest stocks of the FTSE Global Sustainable Yield Asia ex-Japan Index. Now, I know the index is a bit of a mouthful, and the sustainable part is not actually referring to sustainability in terms of environmental sustainability, but it's more to, this is all to do with the ability to keep paying high dividends. And the trio are among the 10 biggest stocks, as you can see, of this index, Asia ex-Japan. As you can see also in this table, the trio pretty much double their weight in this dividend tilted index, this Sustainable Yield Asia ex-Japan Index, as opposed to where they are placed in the parent index, the FTSE Asia ex-Japan Index. The index includes, well, actually excludes those high yielding stocks and actually examines the financial and the operating strength of prospective constituents. So those financials include profitability, capital structure, operational efficiency, and you put specific emphasis in the filtering stage on strong balance sheets and the ability to generate cash flow and sustain the yields. So just quickly as to why they've been able to sustain these high yields and why banks have been doing well with the rise in interest rates. If you can go to the next slide, please, Jason. I'll try and speed it up. For the banks, they make income from both net interest income as well as non-interest income. In the third quarter, the total income was 12.1 billion Sing dollars. 8.4 billion came from net interest income, 3.7 billion from non-interest income. So that, as implied, means that around 2/3 to 70% of the income actually comes from net interest income. Net interest income, it was up on net interest margins, and that's the difference, or the net rate between what banks pay on their liabilities and the rate they actually receive on their assets. So the higher the overnight policy rates, as we discussed before, the generally higher the net difference, as is particularly when that particularly grows as well when rate hike cycles commence. Now, the 3-month compounded SORA was around, as you can see, 3.7% in that red line, and that's up significantly from where it was at the beginning or the end even of 2021, as we discussed before, going from around 0.2% up to 3.7%. For context as well, the higher rates have meant that net interest income has been above 8 billion Singapore dollars each quarter for the 3 banks combined, and it's been above 8 billion combined for the last 4 quarters. For context, it broke above 5 billion Sing dollars in the first quarter of 2018 and pretty much ranged between 5 billion Sing dollars and 6 billion Sing dollars for 4 years, between first quarter of 2018 and the first quarter of 2022, before breaking above 6 billion in the second quarter of 2022. And as we said, it's been at above 8 billion for the past 4 quarters. The loan growth, I should mention, also contributes to net interest income. And here's the thing. The trio actually went into this year positioning for single-digit percentage loan growth. However, they revised that to low single-digit, and that's coinciding with, basically China growth not as strong as we thought it would be, as it was going through a consumer-led recovery rather than investment-led growth. Tech down cycle being more prolonged than we thought, and no reprieve, importantly, for the Fed funds rate. A better outlook for growth next year. In Singapore, we're expected to double up from around 0.9% growth this year to above 2% next year. That has that better outlook for growth and the potentially lower rates next year has actually seen UOB they could have mid-single digit loan growth next year. And what DBS has noted is that for next year, the higher for longer rates, that does support net interest margins. However, there is a likely trade-off with loan growth, and it expects for next year net interest income to be around the levels it was this year, net profit to be around the same levels as well. So overall, the Singapore loan growth has continued to be tepid. It's declined on the higher for longer outlook for the Fed funds rate. And this is an important aspect because the debt servicing ability on broader lower economic growth of their clients is a factor. And because of that, you might see also more competition in the banks as well. So if there's competition for loan share as well, you could also see a reduction in yields on the mortgages and the corporate loans. Okay, so that could also play into it. But basically, the other side of it is 30% non-interest income, which comprises activities like wealth management, the cards business, trading, insurance, and so forth. That has also been growing. It's also surpassed 3.5 billion Singapore dollars a quarter combined for the trio over the past 3 quarters. So I just wanted to quickly go through and just show how the banks are making their money. They have been making the money on the higher interest rates with the growth in net interest income. For the whole 3 quarters so far this year, your net interest income for the 3 banks was up 30% year on year, and the non-interest income, not to be forgotten, was also up 22% year on year. And as I said, this is a big important cornerstone of the STI and a major reason why we maintain that high dividend branding. But straight on to S-REITs, please. If we can just go through to the next slide, please. Thanks, Jason. So the global REIT market has had an impact on the local REIT market. 70% of the market cap of global REITs are, of course, coming from the US. So what happens in the US does have a tidal impact on the global REIT market. And that's particularly when it comes to the impact that high interest rates can have. You've also got that 70% of the market in the US, which is, as we saw in the US Fed Reserve's financial stability report released recently, there has still been increasing concerns about inflationary pressures still leading to the restrictive monetary policy stance, and therefore losses or prospective losses in large real estate, commercial, large real estate assets, particularly in commercial real estate. So this has been one thing that has basically been providing a weight on the REIT market, if you can imagine, because there's so much of it is in the US. It does have flow-through impacts. But as we have in Singapore, we have a really highly diversified S-REIT market. Diversified REITs make up the largest sub-segment of the REIT sector here. The S-REITs are also, I guess, diversified in 2 different ways. They are very diversified in the type of properties they're investing in. They're also very diversified in terms of where in the world they are investing in. As many as 17 of our trusts exclusively invest in property assets outside of Singapore, and 20 of the trusts are investing here in Singapore and outside Singapore. The average gearing ratio of the REITs is 38%. This is below the regulatory limit of 50% if the minimum interest coverage ratio is at least 2.5 times. Okay, and that's imposed by the MAS. The average interest cost ratio at the moment is 3.9 times. Otherwise, if it's not 2.5 times, then your gearing ratio limit is actually 45%. All 6 REITs within the STI have reported for their last earnings season. Financial performances have obviously been varied across the 6. The majority did record a growth in occupancy rates, and they also recorded growth in rental reversions, and they also maintained the healthy balance sheets. The average gearing ratio of the 6 S-REITs in the STI was also about 38% as of the end of September. At the end of September 2023, your one REIT which has basically, as an example, reported for its full year, which ended in September 2023, Fraser Logistics Commercial Trust, its average leverage was 30%, and that's the REIT that has the 3rd smallest, I guess, gearing ratio, the 3rd lowest gearing ratio, after the likes of Sasser REIT and Paragon REIT. Its full cost of borrowings were about 2% 6.2% per annum, and 77% of its borrowings were at fixed rates. And it also had a portfolio occupancy that was at 96%. The logistics and the industrial part was, of course, fully occupied. So this is an example of one REIT which has just recently reported for its full FY. But if we look across the REITs and go to the very last slide, please, Jason, the average dividend yield in the S-REIT sector is around 8%. The index trailing yields are at 6%, and you've got a forward yield of 6.9%. By comparison, the Singapore 10-year bonds were at 3.4% at the end of October, but they're now just less than 3.10%. It brings the REIT index premium spread at the moment back to that longer term average, which is about 380 basis points premium of where your REIT index REIT yield is compared to where your 10-year bond rate is here in Singapore. As of the end of October, the REIT price book ratio, it got down to 0.79 times lows. But as we discussed, a little bit of a change in the paradigm with the Fed on the 1st of November has seen that PB ratio rise back up to about 0.84 at present. The PB ratio does move. It was as high as 1.1 times, 1.0 times in February, and the declines this year we've seen it has been in waves. Now, back in Feb, majority expectations back when the PB ratio was 1.0, your majority expectations that the Fed funds rate now would actually be 100 basis points lower than where it is actually now. So the market was a lot more dovish back then in terms of their expectations and for what has actually happened. Looking forward, the majority expectations now, as Ridesh was saying, is that we could have up to 100 basis points of rate cuts next year. All this very much hinges on the US continuing to make progress of reducing inflation to 2% levels and the ongoing impact of rate hikes already made, as we said. But much of this success in the S-REIT sector, it has been attributed to the comparatively high distribution yields. As we said, having an index which is yielding around 6% is comparing to most stocks across the world yielding something like 2.5% thereabouts. This high yield has been a big impact in the retail investor flows and the retail investor appetite for dividends. And if we look at the REIT sector since the end of 2021, it has booked something like 2 billion Sing dollars in net retail inflows. So I'll finish right there, Jason. Thank you. Sorry.
Thanks a lot, Jeff. Little bit overran, but no worries. So, Jeff, before I let you go, we're going to proceed to our next segment, which is the panel discussion, right? And I think the first question is really pertinent to you, and it comes from some of our investors here at SIVE especially, where they began investing in S-REITs in 2021, and I think since then, they've been seeing a lot of negativity in their portfolios. They are currently facing financial losses. So I think it'd be good to hear some inputs from your side as to what are some of the practical action steps that they can take next.
Yeah, well, hopefully you weren't just investing in S-REITs because, as we said, since the end of 2021, interest rates have seen a big structural change. If you were investing in S-REITs and currently facing financial losses, maybe you went lump sum and that might have helped contributed. But steps you should take next, I'm not necessarily convinced you should. It's not up to me to say you should be buying more S-REITs because they could recover soon. That might have been what investors or the agencies had been saying to you for some time. But I would be maybe looking at, if you could go back to 2021, maybe it was the tradability of the S-REITs that might have been steps you could take because you did have quite a lot of I guess Fed speak, a lot of swings, the pendulum moving from right to left in terms of where rate hikes would be or whether we'd have less rate hikes. And that had a pretty big market impact on the REIT sector. And therefore REITs were more, potentially more suited to traders than it was investors. But it's a tough one to answer because we're all looking on forecasts at the moment. We are expecting rate hikes. We are not expecting rate hikes. We're expecting rate cuts next year. Now, if inflation comes off very quickly or more than we expected, or there's some events globally that do see a quicker cool down in growth, then this will bring pressure off interest rates. So the steps you should take next is be watching the markets closely in terms of signs that there will be sustained decreases in interest rates. If it's because inflation is coming down very quickly, then that would obviously be a positive. But if it's going down because growth is coming off very quickly, that might not be such a positive. So it really depends on what steps the global economy take next. And then that would be whether that would help influence on what you do with your REIT portfolio.
All right. Jeff, I'm just going to put a pin in there. I want to pull in Gerald. Gerald's been keeping pretty silent throughout.
Sorry, Gerald.
Right. So, Gerald, I'm just going to pull you in and hear what are your thoughts on this as well.
Well, I think whenever I make an investment decision, I'll always go back and think about why I had invested into this particular stock or REIT in the first place and constantly reevaluate that. So, for example, if I had begun investing in S-REITs in 2021, I'll go back and think about what were some of the reasons that I had bought into this S-REITs back then. It might be because I thought that some of these REITs have got good fundamentals. So I'll go back and reevaluate the fundamentals of the S-REITs. Do they still have good occupancy rates? Do they actually still have got good rental reversions? Then I'll look at maybe because I think that it has got a good financial position back then, I'll go back and look at whether it is still the case today. So for example, if the gearing level is still something that is acceptable given the interest rate environment that we are in. And then maybe last but not least, if I bought into the REITs because they were offering me 5% dividend yield back then, I'll look at what is the dividend yield that they are now offering. And I think based on the slides that were shared earlier, at this point in time, you're looking at interest rate that is a dividend yield that is actually close to 7%, and that is above the 10-year Singapore government bond yield. So then the question is, within my whole portfolio, does that still appear something to be attractive to me versus other things that I can potentially invest in? So go back and reevaluate the fundamentals and why you had invested in the S-REITs in the first place. And if it helps in terms of your mindset, we can always use some of the different approaches, such as a dollar cost average approach to buying the S-REITs. If we don't actually want to be, say, putting our money into the S-REITs at a lump sum basis and trying to catch the bottom.
Yeah.
All right. Thanks, Gerald. And I think, Gerald, since you interact with a lot of, I would say, retail investors, and I think you can really represent the voices of them on this panel. I think the next question, which is actually a question that a lot of us get these days. And I think if you look at the current situation where there are a lot of alternative investment options with higher yields, right? So you talk about, say, cash management solutions, T-bills, FDs, right? So if you contrast that together with, say, something like REITs itself. So the question here is, why should someone look at investing into S-REITs at this particular point of time?
Okay, so I think that's a very good question because I think in terms of the queries that we get, in terms of traffic that we see to our website, definitely there is a lot of interest in treasury bills in terms of fixed deposit. But in terms of Singapore REITs, the question is why should someone actually still look at it at this point in time? I think our approach towards investing is that to be able to see us through different parts of the market cycle, it is always important to have diversification. And this diversification is not just in terms of asset classes, but also in terms of the time horizons that we are looking at in our different parts of the portfolio. So using T-bills as an example, I think that is a very relevant example because commonly we get the question, are T-bills risk-free? Should I put 100% of my portfolio into T-bills since I'm able to get 3.7% over the next 6 months or 12 months? But while it is something that is guaranteed by the Singapore government, we also need to think about other risks that can potentially come through if we were to put all of our portfolio into T-bills. So, for example, one aspect that we might not think about so often is actually this thing called the reinvestment risk, which is effectively what happens after 6 months. Are we still able to get such a good interest rate? And if interest rates were to be coming off based on what the CME Fed Watch 2 is now telling us, then would it be too late to be switching our portfolios into S-REITs or stocks at that point in time? So I think the key is really that different asset classes offer us an ability to look at different risk-reward profiles. And I think for the S-REITs at this point in time, given the depressed valuation, given the yield that you're now able to get on the asset class as a whole, that might be something that investors can potentially look at if they want to be getting a higher yield compared to the treasury bills, and then being able to get potentially some growth exposure as well when some of these REITs are able to get higher rental reversions.
Fair enough. Ritesh, let me just pull you in right now in this discussion, and I'm sure you have a lot of questions from clients as well who brought this aspect about different deals up.
Yeah, I think Gerald covered it really well. The fundamental question that people need to ask is, what are you really trying to solve for? And the two questions that we just addressed right now, I think starting with this, where, for example, right now there are a lot of options available for investors to get some returns, but is that what you are trying to solve for? If you're just trying to save better, yes, maybe a T-bill, a fixed deposit, some cash management solutions might be okay for addressing your short-term money needs, right? So these are monies that you need in a more near-term basis. You don't want to take excessive risk, and you are okay to get a lower return, but you also get much more certainty in terms of what you get through them. So then I think it's the right thing to do when it comes to what objective are you trying to solve for. But if your objective is to generate long-term income, if your objective is to grow your wealth, then these will, in time to come, as Gerald mentioned, like there will be reinvestment risk, there will be other risks, and it will not really, beat inflation. And that's the biggest thing that you should be worried about as an investor. So if you really want to beat inflation and, accumulate and grow your wealth for the long term, then you have to look beyond these very traditional kind of investment options. And while the path and the journey might be bumpy, it does not mean that you should be disheartened, right? So there are periods when it comes to investments, there will be periods of downturns. There have been periods of even 10-year downturns. But the fact is, people who remain patient and invest with a consistent strategy over time will, benefit from the aspect that there will be recovery and there is generally growth in the market over the longer duration and all. So if you go back to the slide on S-REITs as well, like people who have invested into S-REITs since 2021, just to show how exactly clients have fared. Jason, if you can go back to that slide, previous one. Yes, so this is how, real returns have been. Like, if you look at S-REITs since 2021, it's been a hard story. And through the last 3 years, it is very flattish to negative returns. And this, again, on the back of, multiple overall macroeconomic and local situations that have unfolded. Now, of course, our own REIT Plus portfolio, which tracks this index, has not done particularly bad. Like, in fact, it has beaten the returns of the index. The reason it has kind of done better than the index is because of some extra optimizations that we do on our portfolio. But even the fact that we are outperforming is not enough, because at the end of the day, I'm losing money. So if I've invested, and I saw this question from an investor as well, I've been invested in this REITs portfolio for 3 years, I'm still negative, and right now, it is hard to contextualize 3 years negative return. I'm getting 3-4% risk-free. What is the point for me to keep, that faith and remaining invested? I think what we need to do is kind of zoom out a bit. And if you go on to the next slide, that's where I think the story becomes a little bit more compelling of why you should be investing. So I think it's really, this 3 years have also been a kind of a blip, kind of, a once in decades kind of a situation where we started off with that COVID pandemic, which led to a big downturn in REITs. It started to recover, but then the Fed started hiking rates. That led to the second downturn. And then when we were seeing, as Jeff mentioned earlier as well, in Jan, when the anticipation was the rates are going to be cut, and we at this point will already see rates to be lower than where we are. That really didn't pan out the way it was anticipated, and that's the reason, the higher for longer guidance from Fed meant that there is another downturn that people have seen in the second half of this year. So the first half very positive. When it came to the first 6 months, the REITs were up, I think, close to 10%. But just the last 2 months since the September minutes of meeting from the Fed, you've seen another downturn coming into the REITs market. But again, as you zoom out into the longer term picture, you go back to 2011, and then you look at the returns, not just from the last 3 years, but you go last 5 years, 8 years, 10, 12 years, you can see that you can get a total return which is in the high single digits. And again, it includes the last 3 years returns as well. So if you strip that out, you're looking at close to 10% annualized return from REITs. So what I would encourage is, given where we are in the market cycle, and with the anticipation that the rates have peaked, if the interest rates, even remain where they are, you are getting a very high, I would say, spread above the government bond yield. And if there are rate cuts coming into the next year, you can see a great price appreciation happening on the REITs front as well. So overall, over a longer duration, clients who invest into REITs can look forward to that 5 to 6% dividend handle. And on top of that, another 2 to 3% minimum kind of growth as well. So that's where the high single digit, view of REITs kind of remains intact. But at the same time, I would encourage investors to diversify, right? So REITs is only one, asset class that gives you a combination of income and growth. We are also seeing opportunities broadly in the fixed income space. So, if you are worried about being overexposed to REITs, there are the bank stocks that you can look at from the standpoint of generating, equity dividends. You can look at fixed income, and you can look at REITs. So if you can bring these things together in a holistic manner, then you have diversified sources of income, and you are, also a little bit more insulated from specific, sector risks and all as well.
Yeah, thanks, Ritesh. And I think I want to save some time aside for some questions from our audience here this evening. There are a couple is really unnecessary. There are a lot of questions, in fact. So I want to jump to the next question that we have for the panel discussion. And perhaps this is a little bit more personal, where if you're looking at your own investment portfolio, what ideas are you currently exploring for 2024? And maybe let's go one round, quick 30-second round, starting with Jeff.
Yeah, it has to be trade recovery, because Singapore is a very trade-centered economy. We are expected to double up our growth next year. A lot of that is on the fact that global growth is expected to expand threefold next year. So looking at more resilient trade, regional trade, supply chains. The big sustainability push has also been super important here, as well as digitalization. So the ideas are really the structural economic themes that are driving the real economy of Southeast Asia.
All right, thanks, Jeff. Gerald, up next.
So I think one of the key themes driving the entire market has really been this big interest rate movement. Over the past 12 months, we've just seen it going up in one direction. And I think based on what Ritesh shared earlier, what investors are now looking out very closely for is when it can potentially be cut. So I think what I will start thinking about is what asset classes can potentially benefit when interest rates actually start to come down, because those will effectively be the sectors that can potentially perform the best in a lower interest rate environment.
Yep.
Yep, agree on that. And finally, Ritesh, quick 30-second.
Sure. I think, just generally echoing what Gerald said as well. I think given where we are in the interest rate cycle, there are huge, compelling, reasons why investors should look forward to both fixed income and REITs as well. Of course, REITs will have other aspects that will determine things for them as well. But overall, if we are generally in that environment where we have reached the peak rates, it gives a little bit more certainty in terms of where the forward earnings and the rental revisions and all of that will come through. So in general, I'm very positive both on fixed income and REITs as we move forward. And also from a return standpoint, clients don't necessarily need to take too much risk going forward to earn very high returns. So if you are a pure equity investor, you can be more diversified and earn similar returns with a good mix of equity, bond, REITs, those kind of combinations.
Okay, a little bit more than 30 seconds over there, but still very thoughtful answer. Okay, so next one, I think let's move on to the Q&A from our audience here tonight. Right, and I think one of the common theme here is that for S-REITs itself, seeing that obviously we are exposed to a lot of what's happening in the global environment. So I think one question from our audience here tonight is that if you look at, say, China property companies, Evergrande, if you look at, say, the Russia-Ukraine war, if you look at what's happening in Israel right now as well. So what's the impact going to be like on S-REITs especially, if you take all this into account? Maybe, Jeff, would you like to comment on that?
Yeah, I guess Rita had a chart before showing how the Fed cycle was impacting the REIT market. There's been other factors. The Ukraine war with the higher energy prices, that did weigh global REITs. Economic cycles also matter. The fact that work from home became so prevalent in the United States meant that commercial properties really fell off. So I think one of the most important factors when it comes to the REIT index portfolio you have to consider is that there will always be challenges in the world that will affect different REITs in certain ways. Now, because a lot of the constituents of that REIT index are very diversified in terms, as I said, the type of properties they're invested in or where in the world they're invested in, then you are going to have an element of survival of the fittest. And those REITs that are being able to perform and outpace the market will generally have the higher weight in the index, and therefore the index is like a passive portfolio on its own, in that if you do have a REIT that's in a particular troubled part of the world or being particularly weighed down by an interest rate or an exchange rate or impact of energy costs, then that REIT itself should underperform and have a lesser and lesser orderly, less impact on the portfolio. So I think that's one important thing to keep in mind.
All right, thanks, Jeff. And Gerald?
Yeah, so I think for those who are concerned about some of these macroeconomic fluctuations, I think the good thing about REITs is that each of them have got exposure to different end markets. So for example, if I want something that is seen to be more defensive, then something that actually holds the suburban malls would usually be seen to be a bit more defensive, because I think even during a recession, we still have to go to the nearby mall to be buying our groceries, to eat out at the F&B outlets. So those will be less exposed to some of these macroeconomic developments, such as the Ukraine crisis or a spike in oil prices.
All right. And Gerald, what do you think that investors should consider if, let's say, they are looking to invest in S-REITs? Is there anything in particular that comes to mind?
I think it will go back to the three things on our checklist. Number one, to be looking at the company's fundamentals, whether it's got good occupancy rate, it's got good rental reversions. Two, the financial fundamentals, whether it's got a high gearing. And number three, in terms of the valuation. So those are the three things that we need to be looking at when investing in Singapore REITs. If you feel like that is too much work for you to be doing, to be selecting the REIT by yourself, then I guess the idea is to get a diversified portfolio of REITs that actually allows us to be able to earn the dividend yield without having to look at each of the individual REITs in itself.
Thanks a lot, Gerald. So I think we are 1 minute from 7 p.m. and I would like to take this last minute to really just thank everyone for their participation, right? So there are a lot of questions, and some of these questions, in fact, I would suggest do reach out to Saif's advisory team, right? The questions about, say, like portfolio allocation, questions about, say, how much allocation should you put into S-REITs in your portfolio. These are questions that can best be handled by the advisory team. So if you look at, say, for example, financial situations, so on and so forth, right? I think these are definitely relevant factors to take into consideration. Right. So
Jason, you're going to keep all these. There's 16 open questions, right? I'd love to weigh in on some of them in written answers. If the attendees can provide their details, I'd be more than happy to respond directly.
Yeah, I think that'll be great, Jeff. Like what we can do is we can collate all these questions and we can send as part of a recap.
Yeah,
we can send the recap alongside, a short article that addresses these specific questions, because I do think there are some important questions that are put in, and we've not done justice to.
Yeah, no, all of them are really important, really good.
Yes.
Thank you.
Absolutely.
Exactly. Yeah. So you guys took the words out of my mouth. We are going to look at doing a recap, right? So we do thank everyone for their participation. Perhaps any last words from our panel speakers today, Jeff?
No, but just in terms of portfolio allocation, always look at the big indices as well. How much of REITs are in Singapore? How much do REITs make up of the global, the big global indices and so forth? We've got a lot of benchmarks out there to work with, and we'll discuss more in the recap. Thank you.
Thanks. And Gerald?
So always diversify and always do your research before investing.
Yeah.
Right. And finally, Ritesh.
Yeah, I think we can maybe end with the product suite slide, so that people generally have a good sense that how they can get exposure to different parts of the market and also solve for different objectives that they have. So we do have cash management solutions if you are looking to save for near-term needs. On income, we basically have a passive income solution, which is fixed income based. The REIT Plus portfolio, I think the yield here is not updated. It's 6.6%. But we also have growth portfolios. And if you are someone who wants to pick up their own REITs and do your own research, you have our own brokerage platform as well. So there you can pick your individual REITs or bank stocks, and you can trade freely depending on what you're trying to solve for. But yes, I mean, if you want to invest in a hassle-free manner, I think these solutions, especially the REIT Plus, is a great way for you to get a diversified exposure to the S-REITs market. And because the index itself, is a narrow index of the most liquid REITs in Singapore, naturally it, keeps the winners, and that ways, your portfolio keeps optimized and all as well. So yeah, I mean, I'll just encourage everyone to think through a little bit more, from an objective standpoint. And if you want to discuss these in more detail, again, reach out to us on our advisory page, and we will definitely do a recap to cover some of the questions.
Yep, that's right. So once again, thanks everyone. Like I said, very short session, but definitely very exciting. All right, thanks everyone. Cheers.
Yes.